Okay, good morning. All right, so I'm going to start today by talking about a few questions that came in via email. I'm just saying in general, you're more than welcome to send questions. Like I said on the first week of class, I probably won't reply to all of you individually to each of your questions, but I will either talk about some of them in class if they are very pertinent to the material we've been discussing, or I will just be happy to follow up with you at office hours. And in any event, I'll make sure to give you participation credit for taking the time to write the email. But there were a few questions that I thought were just particularly relevant, and unless your question was like really good, I'm not going to just name you. But therefore, you should infer that if I don't, name you, then this is how securities law students should start to think that the average quality of questions that are not named must be lower than those that are named. Anyway, so that should bring back last week. All right, so one question related to the quiet period that we've been discussing and the link between the quiet period and non-disclosure more generally. So here, the idea is that we have this period of time prior to the filing of a registration statement where there's no disclosure about the upcoming offering. Now, that is similar to, but distinct in some ways, from non-disclosure more generally. What do I mean by that? Well, non-disclosure more generally does lead to the same kind of informed trading problems that Chris Kraft posed. And hopefully all of you had a chance to read Chris Kraft, because we're going to talk more about it. But Chris Kraft is kind of a unique setting, right? Because in Chris Kraft, Piper was a publicly traded firm. So Chris Kraft brings up issues that are very unique to the setting where we're talking about an equity issuance by an existing public company. And in that setting in particular, there is a substantial overlap between non-disclosure of some material information, some information that matters to investors, and the quiet period. And that's, if you remember reading the opinion, hopefully you read it last night, the dissenting judge was particularly concerned about the risk of fraud liability, of a violation of Section 10 of the 1934 Act as a result of not disclosing the $80 price. Nod your heads if you're remembering that in the dissent. So Chris Kraft brings up a set of issues that are very unique to the setting of a public company that is contemplating issuing shares and wondering how much information should be disclosed to investors. We're going to touch on that. We're not going to go too deep into the existing duties that apply to public companies under the 1934 Act, because we haven't gotten to the 1934 Act. The 1934 Act, just at a high level, requires that public companies like Piper provide information to investors. Now, one point that we're going to learn quite a bit about over the next, and maybe 4 or 5 weeks from now, is that the 1934 Act does not require that public companies like Piper affirmatively disclose any material fact to their investors. So there is not, under the 1934 Act, a general duty of disclosure of any material information. That's a point that we will return to and is really essential to understand. And I think most people probably would find that surprising. It is simply incorrect to say that publicly traded companies like Piper must disclose any information that would matter to their investors. That is not the law. Instead, what we have under the 1934 Act is a regime by which certain categories of information must be materially let me say that differently. Certain categories of information are considered material to investors and therefore must be disclosed. So you must have a material event that occurred within a set of categories that the law specifies. But what we do have is a general prohibition on misleading or fraudulent disclosures. So we'll break this down, but Section 10 of the 1934 Act, 10b in particular, prohibits the disclosure of information that is misleading or that would contain an omission, that contains an omission such that the failure to disclose some other piece of information turns the disclosure into a misleading disclosure. So we're going to break that down, but there is a general prohibition in this general anti-fraud statute under Section 10b against the disclosure of fraudulent information, either an affirmative misstatement or an omission of information that turns what you have disclosed into misleading. It's actually, I think, a very interesting, analytically, much more interesting than Section 5 area to think about, because the contours of what constitutes an omission, what constitutes a misleading statement are really analytically challenging, and there's a lot of depth there. But here, the simple question was, did Piper have to disclose the $80 figure in order to not violate Section 10b? And what the dissent argues, the dissenting judge is very concerned about the possibility that Section 5 will be construed in such a way, so narrowly, that disclosing the $80 figure would be a violation of Section 5, and not disclosing the $80 figure would be a violation of Section 10b. Not because, again, there's some general duty to disclose something material like an $80 price or an $80 valuation, but because other information that Piper would provide about the exchange offer, about the BP offer, would be incomplete, would be misleading in some way if it did not include the $80 figure. So the dissent is very concerned about this. Now, who remembers from having read Chris Kraft what the majority opinion has to say about this concern? They just have a great line in the opinion if you looked at it last night. Who or has it now in their computer and wants to share what the majority opinion had to say about this concern that section, well, let's just say the 1934 Act. It actually refers to a different part of the 1934 Act in the sentence that I'm looking at, but it's the same discussion. Does anyone see this? I'm now giving you hints if you're Googling, if you're Control F, 1934 Act. Well, this is what I did when I was sitting on the other side. Just Control F, 1934 Act. Anyone? Nobody? So a lot of you, I don't have checks next to your name. I'm surprised. Nobody wants to? Wow, okay. All right, so page 7 of the PDF from Westlaw, page 576 of the opinion, is the fact that a few additional and sophisticated investors could have discovered the $80 value guarantee in the description of the transaction, which Bangor Putna filed with the SEC pursuant to Section 13D, we'll come back to that, is of no moment. It just doesn't matter that you might be misleading. And then they further say, further down, that to hold, further down in the next paragraph, to hold that disclosure would be privileged here because the $80 value could not be kept secret and might affect the market would mean that many other companies could offer to sell securities before their registration by claiming that the terms of the proposed offer could not be kept totally secret and therefore must be disclosed in full. So the majority kind of dismisses this concern very, very quickly, doesn't seem troubled by what the dissent is troubled by. And just so we're on the same page, if you look at the dissenting opinion, Yeah, so if you look at Lombard's dissent, which is, we can look at page 580, he says in the third paragraph on that page, the majority intimates that the $80 figure was not a material fact, a suggestion with which I cannot agree. The test for materiality laid down in Texas Gulf, we're going to learn Texas Gulf, is whether the fact to which a reasonable man would attach importance in determining his choice of action in the transaction in question. On May 8th, Chris-Craft was offering $65 for each Piper share in a taxable exchange. No reasonable man holding Piper shares on that date would find unimportant the fact that Bangor planned to offer in the near future a considerably more attractive package of securities with a value of approximately $80. So while it may seem somewhat perplexing to you why he's citing Texas Gulf, it won't seem that perplexing in a few weeks when we learn that Texas Gulf is construing the materiality requirement that applies under the 34 Act, and particularly in the context of anti-fraud liability under Section 10. So what the dissent is saying is, look, it's not something we should sweep away so quickly, this concern that you might be tendering at 65, unaware that there's an offer potentially valued at 80. So to return to the question is that I got via email was, look, isn't this the same as non-disclosure more generally? And the answer is yes, but here there's a market price, right? There's a very clear market price that's being offered. Piper is a publicly traded firm, and the question that investors, the shareholders of Piper, are facing is whether or not disclosure of the $80 is something that's material to them that would affect their decision making, and that question doesn't always present itself in IPOs, and certainly wasn't within the ambit, I would say, of what Congress had in mind, or what the SEC had in mind when it architected the quiet period as a period of time to ensure that the registration statement was the only moment when a company spoke. So this case presents some unique challenges, but it does call into question whether the Section 5 regime makes sense, at least for publicly traded companies. Now, the tension between the 1933 and 1934 Act is one that the casebook talks about, is a pretty deep tension when you think about publicly traded firms like Piper who face dueling obligations under these two statutory regimes. But the question, what the majority seems really focused on, is if you're making this tender or not decision, is it somehow better for you to have all the information in that registration statement about the value of BP's shares, rather than being told up front that the package of compensation was valued at $80? So the key to realize in this opinion is that what's bothering the court in Chris-Craft, what's really at the heart of the dispute between the majority and the dissent, is whether the shareholders of Piper are entitled to more information about BP stock, because it was an exchange offer, right? So would the same considerations apply if it were a cash tender offer? No, right? So if it were a cash tender offer, would that be the kind of information that could be disclosed immediately upon reaching the agreement, upon announcing that this agreement had been reached? Raise your hand if you think that a cash tender offer, an $80 could be. Do you have a comment on this? You disagree? You agree? Yeah. Yes, definitely. Definitely. Why is that? Now you should have the machinery to understand, to analyze why a cash tender offer for $80 from BP could have been disclosed immediately. Yes. Let me make sure I got you. Caitlin? Yes. I already have you. Yes.
I guess it goes back to what we were discussing last week, the price of fully revealing that might be going to go through the question of having one or Lloyd's traders, because the price offer is right there.
Good. So Caitlin points out there's an $80 price that would be offered. But if you think about, okay, so if you think, say it's Monday, the agreement is reached, and BP wants to preempt the Chris-Craft. Chris-Craft is accumulating shares in its tender offer, so it's getting closer and closer to the 50% magic cutoff. And so BP thinks, what we want to do is we want to tell everyone that, like, you're tendering at 65 right now, but there's an $80 cash offer here. We want to rush to the market and tell the market ASAP so that people don't tender. So what would that do to the price of Piper stock? So Kalin points out what it would do to the price of Piper stock is it would very quickly, that information would get very quickly impounded into the price. There would be no opportunity for informed trading if that disclosure were to happen. So economically, that's right. Economically, the cash tender offer conveys less uncertainty than the exchange offer, although the cash tender offer is still only paid if BP were to reach 50% or more of the shares. Okay, so it's not that it's without any uncertainty. Just so we're all on the same page, even a cash tender offer, while the number is cash and not based on some valuation of BP's shares, it's still a cash, it's still an uncertain offer, right? Because it's only paid if, in fact, BP acquires more than 50% of Piper's stock. But there's a simpler legal reason why there would be no Section 5 violation if BP were to announce, Monday we signed the agreement, Monday night there's a cash tender offer, don't tender your shares to Chris-Craft because we're going to offer you $15 more if you tender to us. What's the simple legal reason that would not be a violation of Section 5? Let me get someone in the back. Yes. Make sure I have you check. Christian. Yes.
Yeah.
Yes.
Is it because it wouldn't be a public offering of stock?
Right. There's no securities issued. Exactly. So a little trick question, right? So the Section 5 here is implicated because BP is issuing it's issuing shares. So by that I mean the firm, Bangor Putna, is actually adding to the number of shares that it has, or issuing shares that it has already authorized in its charter. It is selling shares. The reason why it's swept into the ambit of Section 5, remember the definition that apply in Section 5, it is selling shares to Piper shareholders, right? They are trading their shares for BP shares. So it's because there's an exchange offer that there's an issuing of securities by BP. So the question at the heart of Chris-Craft is really whether the $80 figure in the context of an exchange offer is a bad idea to give investors prior to disclosing the entire registration statement for those securities. That's really the question. And to sort of see why the majority opinion isn't as crazy maybe as I made it sound yesterday, is to think about the risks involved if you're a Piper shareholder. So if you're a Piper shareholder, you're trading shares in a publicly traded firm where the valuation is known to all and can be easily transacted in liquid markets. You're trading them for the shares of an acquirer that don't have a fixed market price, a public market price, that are valued based on some valuation that you don't exactly know what went into that black box. And so to evaluate what went into that black box, the court feels very strongly that you're entitled to have all the information in front of you in that registration statement. Now, who finds that logic? Who can find a flaw in that logic? I mean, there's something wrong with that, I think, even just on the level of the law. Forget about economics for a minute. Just think about the logic of that argument. Can anyone see why there's something wrong with that claim? The claim is, let me just say it one more time, that you might tender your shares, if you're a Piper shareholder, on the basis of some valuation that led to that, some black box valuation, you don't know what went into it, that led to that $80 number, but you haven't seen the registration statement yet, and so you're going to go along without getting the full picture when you decide to tender your shares. And you might not believe that it's $80, or you might find out that $80 was a meaningless number. I mean, but there's something wrong with that. Can anyone see the problem? This is kind of to some extent what's bothering the dissent, I think. No? Anyway. So think about this, right? What is Section 5? What are we talking about? We're talking about the quiet period, right? What does Section 5C prohibit? Offering. Great. Offer to sell. Thank you. Prohibits an offer to sell. What does Section 5A1 prohibit? Selling shares. Could you actually have exchanged your shares if a registration statement was not effective yet? No, right? You cannot exchange your shares until a registration statement is effective. And in fact, BP wasn't even proposing to effectuate the transaction without the registration statement having been filed and declared effective. BP was well advised by lawyers here. It certainly wasn't intended. There was no sort of, give me your shares now, and we'll actually do this in violation of Section 5. That is, we'll effectuate these transactions before you've seen the registration statement. That was never on the table. The only question here, while we're spending 25 minutes on it, right, is like, in between the window of time when there was the press release and when the registration statement was filed, might you be swept away by the $80 figure? And it be so baseless that after the fact, once you've seen the registration statement, you will have been harmed in some way. Like we said, that defining harm, overpayment is kind of tricky, right? We've got to think about consumption. I mean, like I was talking to one of your classmates about this after class. Think about it's easy to think about the case where you might have overpaid for Piper. So it turns out that it wasn't 80, that it was 50. And you believed that BP stock is actually a lot less than what it seemed, right? Nod your heads if you're with me. So what? So you tendered, you found that out. Now, you might say, look, that actually hurts these investors. But remember, there will be cases where they'll be pleasantly surprised. Imagine if you had bought Facebook, or you had bought Google, or you had bought, right, so buying into an IPO or buying into an exchange offer, in and of itself, on average, that is not a losing bet. So remember, you got to really construe a story whereby these investors would be harmed, not just by the lack of, not just by the possibility that BP might be worth less than it is, but because they were moved by the $80 figure a short time before the entire registration statement came out, made a decision solely based on that figure, and that particular risk was the kind of risk that they, as diversified investors, should care about. Does this make sense? That's the logic you have to go through to understand why a violation of the quiet period in this way actually hurts investors. And the dissent really didn't find that persuasive. It seemed very speculative, particularly in light of the concern that if there was any good chance that it is worth $80, if you're a Piper shareholder, that's something you deserve to know before tendering at 65 to Chris Kraft. Does this make sense to everyone? Or questions on this material so far? Some of you are like nodding, like this has got it totally. Others of you are like looking at me with a puzzled look. So any part of this unclear? No? Assuming it's clear. Okay. So this question that I got via email about whether or not, informed trading and non-disclosure are unique to this setting, or whether or not this is similar to what we see in other settings. Here in this opinion, we're pitting these twin concerns, right, of informed trading and disclosure at odds with each other in a way that's really tough. It's really tough to come out one way or the other. Let me ask you a hypothetical, one you might see if you were, advising a client or taking an exam. What if BP were a publicly traded company in a liquid market with a price that you could just look up online if you were a Piper shareholder? Violation of Section 5 to announce that compensation, that exchange offer, before the prospectus is filed or not? Before the registration statement is filed or not? Magdalena.
Would Piper fall under this well-known seasoned
Let's suppose we don't have the well-known seasoned issuers, which we'll get to shortly. The facts of Piper on their own, right? The facts of Chris Kraft on their own. So let's take the case as it is, but just change one thing, which is that Banger Putnam's offer is not for a mix of cash and equity that's valued at $80 by financial advisors. But BP is actually a publicly traded company, and so the price of BP is known to everyone. And we could say that price is $80 and that's all you're getting. We could say the price is $60 and you're getting $20 in cash. But the $80 now consists of cash plus the price of a publicly traded company. Same result? What do you think? Let me see if anyone else. Same result? Different result? Who thinks it's the same? We'd have the same outcome, that there would be a violation of Section 5 to announce that offer. Yes. Why? You know I could call on you. But that's okay. I'll give you Isabella, right? Yes. I see. Oh, nice. Good. So the price is going to be frozen. Very good. So Isabella says, look, the price is going to be frozen as of the moment you choose it. So if you're going to say that it's valued at 80, but then it dips to 75, maybe not all investors will be aware of that update. Good. And in fact, one thing we know from corporate law, if you're taking corporations, is that acquirers like BP tend to have negative stock returns, meaning their stock price tends to fall upon announcement of an acquisition. The idea is that you probably overpaid. This is sort of true in general. You read about the winner's curse, right? If you won an auction, you probably paid too much for it. Remembering this from the case book. So if you're the highest bidder, what does that mean? That means that there was someone behind you, and you probably could have paid just a little bit more than they did. Hence, you always overpay if you're the highest bidder. Nod your heads if this is all okay. So one concern, the court might still be troubled by the fact that the price as it stands on the date of the offer, of the exchange offer, may in fact not just be incorrect, but may be biased. It may be, even on average, right, across hundreds and thousands of these, likely to be an overstatement of the worth of BP rather than an understatement. On average, even. Great. Excellent, Isabel. Put you on the spot, but you killed it. Great. So who else thinks that it wouldn't be a violation of Section 5? Yes. Christian.
Well, I think the court kind of touched on that when it was discussing this case, and they said, sophisticated investors could have, gauged how much this offer was worth with the description filed with the SEC, and, that's of no consequence. So I think unless they announced the cash plus whatever the price is, that they'd be fine to just announce that those two things were offered.
Well, it's true. We're going to look at Rule 135 in a minute. If they just announced, they didn't include a number, I agree with you. You're absolutely right that if they had stayed within the contours of Rule 135, which we'll look at in a few minutes, or they had refrained from pinning a dollar value, then they would certainly be in the clear. But I want to know, let's take someone who disagrees with Isabella, that is, if the price were given, that it would be just fine, because that price is the price of a publicly traded firm. This is like an exam question, right? So I'm just making sure you don't feel like you weren't prepared, okay? So you want to argue both sides, right? So you want to pick up on Isabella's point, absolutely, when you analyze this, and she makes a great point, which is like, look, the price is just at a particular moment in time, and it can change. Who can articulate an argument for why it would be perfectly fine? Let's take the zero cash. There's no cash in the offer. It's very simple. BP just says, we'll offer our shares, which currently trade at $80. Therefore, the value to you as a Piper shareholder is $80 because we are a publicly traded company. We're doing a one-for-one share exchange. One share of our firm is $80. Who thinks that, yes, Michael, would not be a violation of Section 5?
Well, I guess you can make the argument that you're not offering any new information, that the current share price is publicly available. Even if they didn't state it, it wouldn't be a violation of Section 10b because it's out there for everyone to see anyways.
Good, but the majority, right? So okay, great. So the dissent's concern that there is something misleading about not disclosing that information would be mitigated if you're to say, look, that information is already out there in the public. But which way does that cut? So if it would not be misleading to omit it, I think you're in the same line as Christian, right? You're saying, look, I could leave that out. I could stay silent, and it would not violate. Tell me if I'm misconstruing your point. It would not violate the anti-fraud rules. Therefore, I could stay silent. Therefore, you're kind of in the same camp as Isabella. You would rather the firm not. You would rather BP not post the price, so as to not mislead investors, because remaining silent, you argue, can't mislead them since they can find out the price elsewhere, which was the concern that seemed to motivate the dissent, that they didn't know what went into the black box. But that puts you on the same side of the issue as Isabella, although it's another great point, because what you're saying is, look, not only would it be misleading to disclose we're trading at 80 right now, but it would be not misleading to remain silent about it because you could go look up the price. So another argument in that direction, another good one, but still on that side, right, of the issue. So you're still on the, if I understand correctly, you're still in the camp of don't put a price in the exchange offer before, don't put a value, don't put a number in the exchange offer before the registration statement is filed. Does anyone think that it would not be a violation of Section 5? This is actually where I come down. Not that it matters, like for an exam, right? Like you just have to do both sides, right? But yes. Do I have you? Yes, Wei-Jin, gotcha. Yeah, so Wei-Jin pulls out a nice point from our economics material in the first couple weeks that, look, prices tend to reveal information, right? I think that's right. I think that's right. I think there's a simpler reason why the $80 figure, if I were to say it's $80, if BP were a publicly traded firm, there's a simpler, yes, tell me your name. I don't think I've checked you.
Ophir.
Tell me your name.
Ophir.
Ophir. Oh, I have you, Ophir. Yes, I do. Sorry.
Is it just that, like, if you say we're trading at $80 right now,
yes,
like people do understand that stocks are volatile, so it's not really misleading. Like it's like
right.
if I say it's sunny now, it doesn't. People know it's going to be dark later. I mean,
that's right. That's right. That's right. But you guys are focusing on the fact that what I say might be misleading, which is great, and that's right. There's a simple, yes.
Paul?
Yes, Paul.
So if we view that just doesn't raise any excitement, we're just saying, yeah, that's the price, who knows it,
Yeah, I think you're all in the same, now you're, I think, closer to the more convincing argument, which is that it's kind of like cash. I mean, we said that there would be no violation of Section 5 if the offer were in cash, because there'd be no security being issued. That's true. But the rationale behind that what you should be looking for, right, is to think, well, why is it that cash wouldn't pose a problem here? Like announcing, we're going to offer you $80 in cash. That clearly wouldn't implicate Section 5 on its face formally, because there's no sale of securities by Bangor Putnam. But there's a more sort of logical reason why cash wouldn't raise these concerns, and that's because cash is cash. There's no uncertainty as to the value, which is what Wei Jun was saying, but I'm just going to kind of tweak it a little bit. It's not just that prices incorporate information. It's that value is sort of certain when it's cash. And the value of BP at that moment, if BP were a publicly traded company, like the value of BP should incorporate the value of the share should reflect the actual value of BP if it's a publicly traded firm. So it's like 90% what you were saying, Wei Jun, right? So I think the only thing I would tweak is to say, I don't think it's because necessarily when you said revealing information, it's not exactly the same kind of revelation that we discussed in the bid-ask spread example, but it's very similar, which is that it's a publicly traded firm, so these incentives to impound information into the price are very strong. Now, of course, Isabella is right by saying, look, the price will then probably drop. And so the $80 might be kind of misleading. But as Ophir says, all you have to do is just qualify it with like presently trading at $80. So I mean, if you qualify it as presently trading at $80 a share, there's something about that that I think would bother the court a lot less. And there's a reference to that in the opinion. See if I can find it here. Yeah, this is in the dissent. So on page 580, really at the transition between 580 and 581, what the dissenting judge says is, look, the need for fair and equal access to information about the terms of a tender offer must be balanced against premature and incomplete disclosure of a securities offering in contravention of the registration and disclosure requirements underlying the 1933 Act. The conflict is sharply posed when, as here, the merger agreement sets only a value for the exchange package with the underlying securities left to be determined later. You all understand why that's the case. The value of BP's stock is not fixed anyway at any moment in time. It always fluctuates, right? So it's $80 as of today. And this is why I think Isabella's critique proves too much in a way, right? It's right, but I think it takes us a little bit too far because it's always true that an exchange offer, right, pins a value today and in the future may be fluctuating. And the court says, and the dissent says, look, when the securities to be offered are not specified at the time of the announcement, the investing public cannot even begin to make an independent evaluation of the offer. So if you're not even saying what the shares are, there's a problem. But then there's this footnote 1 where the dissent says, look, this situation must be distinguished from an agreement stipulating that the undetermined securities are to have a certain cash value. This can occur when the tendering company promises to offer only widely traded securities in its package. Then the market price of widely traded securities as of the date of the exchange becomes effective, determines the exchange ratio. There the public is fully protected, and I can see no arguments against full and immediate disclosure. I think the majority would agree with this. It's not in the opinion. They didn't address, but I think it's pretty clear why. So the idea that you would not disclose an offer that is an exchange that is based on exchanging your shares for the shares of a publicly traded firm, the idea that that would violate Section 5, I think, takes us really far into the land of non-disclosure. And even the majority, it's my sense that the majority would agree that this footnote 1 was not a controversial part of the opinion. The issue here, and by the way, how do you know this? What basis do I have for guessing that that's how the majority would think? Well, if you go in the majority opinion and look at the way they describe the $80 valuation, you can see this is on page 575 of the opinion. I'm just going to start. Well, I'm just going to start with the paragraph that's the first full paragraph on 575. Here is a statement of the value of the securities Bangor Putnam offered was made directly in the announcement. It is true that the value which the reader of the May 8 press release could be expected to accept is a value based on the opinion of a reputable financial corporation and not upon general and necessarily speculative facts about the nature of the offerer's business, as in Arvida Supra. We didn't talk about this in Arvida, but there was no financial advisor in Arvida like there was here in Chris-Craft setting this value. But Arvida was such an extreme case of clearly being an offer that we didn't stop there, but that's a point worth noting. Here's the key. However, the true significance of the $80 value which Bangor Putnam claimed for its securities package was nonetheless unclear. This is what's bothering the majority. Chris-Craft charges that the figure constituted an outright misrepresentation, inasmuch as most readers would construe the figure as representing the market value of the package. In fact, Chris-Craft charges some of the securities in the package had not previously been sold on the market at all, as we said, and the market value of Piper shares never reached $80. Remember our conversation yesterday about informed trading in response to the Bangor Putnam exchange offer, so that the Bangor Putnam securities did not have an $80 market value and cannot honestly have been thought to have such a value. Sidebar, that doesn't make any sense, right? Because as long as there's less than 100% chance that the deal will go through, it will never reach 80. You should see that immediately from the conversation yesterday. But that's their aggressive litigation posture. We need not reach the question whether prudent investors would have if it would have been assumed, as was apparently the case, that the value referred to was based on such considerations as Bangor Putnam's earnings and asset value. It is enough to point out that the SEC had no way of checking the honesty of the figure, and that the public did not receive the detailed information it would have received if a registration statement were filed. I'm just going over what we said before. Here's the point. Such information would have eliminated the possibility, perhaps the probability, that some persons would have construed the $80 figure as referring to market value, when that value is neither accurate nor intended. So see, what the majority is saying is that the $80 is not actually the market value of BP stock. That's what's bothering them. And that concern would be eliminated if the stock were, in fact, if BP had publicly traded shares that were trading at $80 at the time of that announcement. Because then we'd only have a small step forward in the direction of Ophir's comment to address Isabella's concern, which is that we just need to qualify it that it might change. But at least there's something behind the $80, right? At least the $80 isn't a speculative guess that may be wildly overstated. That's Chris-Craft. Questions on Chris-Craft? I want to make sure this is clear because, you know, if you get a problem like this, you need to argue both sides, okay? And you need to really think in the facts that you have why it is that we would want Section 5 to apply, why it is we want to be prohibiting trading. Remember to connect, after you do this legal analysis, connect it back to the broader economic rationales. Okay? Remember to talk about informed trading. Remember to talk about the possibility that even absent disclosure, prices will update. That can weigh against requiring disclosure. It can be a consequence of construing Section 5 narrowly, or it can serve, as the court did in Chris-Craft, as Chris-Craft argued, and the majority, stated this argument as not necessarily accepting it, but kind of mentioning it. It can serve as sort of evidence of the fact that the offered price may not be the accurate price. Does everyone see this? So the conversation around informed trading serves multiple functions. One such function is as an evidentiary kind of role of saying, look, if in fact the value were 80, then someone should have traded it up to 80. Traded what up to 80? Well, at a minimum, Piper shares, because that's certainly what you get. Of course, that's wrong, right? I'm just restating the points we covered. That's wrong because it will never reach 100% certainty until it does, but it should be close. And so if you have a fact and a fact pattern that says, like, 1 week later, the Piper shares were at 65, that would be a fact you would want to bring out and say, look, this suggests that, in fact, informed traders didn't believe the $80 valuation. Why? Why would that indicate it? Because remember, they're getting shares of BP. It's not a cash tender offer. If the facts are a cash tender offer, then you're getting $80 cash as long as you hit 50+%. Is this crystal clear to everyone? Make sure the steps are straightforward. You'd start with Section 5, right? Start with the statutory definitions. You'd then look at whether or not the facts at issue constitute an offer. If that's an issue presented by the hypothetical, you would argue both sides, much like Isabella and Ophir did, sort of saying, look, we can construe it one way or the other, but then try to reach into the rationales that are coming out of Chris-Craft in particular in this setting, okay? And then link it back to the broader economic implications of mandating disclosure or allowing informed trading. That's how you write an A answer to this in this setting. So nobody feels like they didn't have the roadmap, okay? Any questions? Any at all before we leave Chris-Craft? No? Okay. All right. Rule 135. So what is an offer? What is an offer is anything, whatever, but except for things that are covered by Rule 135. All right, what does Rule 135 say? Someone give a simple synopsis of Rule 135, which is very similar to what Christian said earlier. What do you have to do to come under the wings of Rule 135 and be sure that your communication does not constitute an offer? Yes? You say it's not an offer. Yes. 135A1. Candace? Yes. You say it's not an offer. That's right. What else?
In addition to the legend, you can include the name of the issuer, stuff about the securities, the purpose of the offering, but you can't include the price.
See, there seems to be this problem with including the price. SEC does not like you including the price. Okay, we talked a lot about that. So 135 says if you don't include the price, you can, in fact, talk about the fact that the offering is going to happen. You can talk about that fact. Can you mention the name of the underwriter? This would be easy. No. Why is that? Why can't you mention the name of, is there any rationale to that?
I presume because they all have reputations, and some might say, oh, John Snow is underwriting this transaction.
Yeah. 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 I guess I'm trying to think, so it all goes back to this, we want to prevent hyping up investors. But remember, they can't actually buy yet. So when they see the registration statement filed, they're going to see who the underwriters are. So it's this very transitory phase when you're worried that investors will get all excited because Goldman Sachs is underwriting this offering. Go figure, right? I mean, some of these rules, you really got to think hard to find a rationale. But if your client asks you to stay within the safe harbor of Rule 135, you need to know what the requirements are. I mean, you would advise your client, don't talk unless you stay within the following parameters. Don't talk about your offering, right? Okay, so what can underwriters do then if they want to have a conversation about the offering? Because 135 does not give underwriters much protection. In fact, you might say that what's motivating Rule 135, and this was certainly the case in Arvida, and I believe to Chris-Craft to a lesser extent, actually in the majority opinion of Chris-Craft. I thought we were done with Chris-Craft, but there's this one sentence I'm going to read on page 574. Rule 135 provides such a checklist, an announcement of the deal. And so what the majority is saying is, look, 135 gives you a way to disclose this basic information about the transaction. And in the case of a publicly traded company, that's information that, the minimum that investors should have. And so therefore, you should be happy if you comply with 135. OK, so 135 protects issuers who are put in this tough spot of trying to comply with anti-fraud law, trying to make sure that their own shareholders understand that there's a transaction like this that's contemplated. But what if you're an underwriter? What if you're an underwriter? How do you build interest in the offering? How do you build interest in the offering if 135 does not extend to you? What can underwriters do if 135 does not protect them? Let me turn on the tablet here. Well, the answer is that underwriters cannot do very much. And that's by design. So let's just review. Let's see if we can get the laptop on here. Let's see. OK. So let's review the timeline. So underwriters can't do very much. Why is that? Well, because underwriters aren't supposed to do anything in the quiet period. Right? That's the whole reason we have a quiet period, is because in between the moment that the offering is contemplated and the filing date, we don't really want underwriters doing anything. On the other hand, after the registration statement is filed, which is what we're going to really turn to now, we're going to talk about this waiting period. And the structure of Section 5 is to bifurcate, to separate these two periods and to really focus the attention on each party separately in each period. So issuers are allowed to speak if and only if they comply with 135 prior to the filing date. Underwriters are never allowed to speak about the offering except for preliminary negotiations with issuers. But even then, you have to be very careful. And you remember that from the definition of sale, what constitutes a sale. But the period during which underwriters can talk about the offering is the waiting period. Now, the waiting period is in between the point when the registration statement is filed and when it is made effective. Now, in this period, we know that Section 5C is not applicable. Right? We know that. We know that because by its terms, it only applies as long as a registration statement has not been filed. However, Section 5A(1), as you remember, prohibits sales Now, here's a question, if you were paying careful attention to the statute. Is there any restriction other than Section 5C on offers nonetheless? So offers are not outright prohibited. Section 5C does not apply. Is there another restriction, or can you just freely offer to sell the securities during the waiting period? Hang on. Anyone else? Christian's got it, but I want to see, are others reading the statutory material? Magdalena, do you know? Right. So what's the statute? Start with the statute. So 5C does not prohibit offers after a registration statement has been filed. Does any other statutory provision, looking for a statute, a number, and a letter, maybe another number? Anyone? This was in the casebook. You maybe could say, I didn't tell you to read Chris Craft yesterday. Okay, fine. You read it last night. But I did give you this material in the casebook. So now, let's see, anyone? Christian.
Isn't it 5A that requires an effective registration statement before you sell the security?
Yep, that's true. But the question here is, are there other statutory restrictions on offers? Yes, Candace. Rule 134 is good, but it's not a statute. It's good, it's a rule. What's a statute that applies? Yes? Ty. Yeah, 5B1. All right. What does 5B1 prohibit or restrict?
Restricts the underwriters from distributing any prospectuses unless it meets the requirements of Section 10.
Good. What is a prospectus? So this is yeah. So let's just jump to the bottom. 5B1 restricts written offers. It restricts the distribution of a prospectus. The casebook does talk about that. So 5B1, so Magdalena had it right. I'm just making sure you start with the statute. Okay, so you want to start always with the statute. This is a statutory class. And so 5B1 restricts written offers, which is really the prospectus. And by restricts, I mean it doesn't prohibit. Rather, it prescribes conditions under which you can make a written offer to sell. In other words, under which you can distribute written materials about the offering. So, by implication, what is always allowed? What kind of offer is always allowed? Yes, this is exactly verbal, always allowed. Verbal offers, always allowed. Exactly. Okay. Verbal offers are always allowed. That is to say, you can always pick up the phone and call someone as an underwriter and say, hey, I've got this security, this IPO you might be interested in. The registration statement has been filed, but let me talk to you about it. What do you think? What are your questions? What are your concerns? What can I help you understand? So oral or verbal offers are always allowed. Written offers are restricted. And the casebook outlines sort of the kinds of written offers that are allowed, and it's dry. Okay, so you've got the red herring prospectus. You remember reading this? You've got the summary prospectus. You've got the tombstone ad. Okay, it's okay. So what is this getting at? Well, so what you need to know is that there are very specific formats that you can provide historically, traditionally, under the statute information to investors. And the casebook lists them, and you can go read about this. This was the preliminary, there's the discussion of the preliminary red herring prospectus. What was this? Why was it called red herring? Does anyone remember? Like historical people like this stuff. Like, where did it come from? What's that? Yeah, well, yes, but there was something in particular about it. It had like the wrong numbers. It didn't have numbers. Basically, the idea was to mislead you. Not really, but to get you sort of not, like everyone would kind of wink and say this isn't the actual prospectus, because the actual prospectus can't be shown to you at this time because the registration statement is not yet effective, but this is like something we're all going to wink at. Securities law has this kind of rich history that you can read about of weird things like that. The summary prospectus for 1934 Act companies. The tombstone ad. By this point in the reading, I was like, yeah, that will be me in the tombstone if I got to keep reading this. All right, so not really. Section 2, yeah, so you can, there's a nice picture, to be fair, there's a nice picture, okay? A nice picture of a tombstone ad. And it looks like a tombstone. And that's where it comes from, not because it looks something like that, you know. Okay. All right. So that was sort of the classic set of written documents that you could disclose until the introduction of what's known as the free writing prospectus. Now, in the world today, we have much more flexibility when it comes to written offers to sell, because the SEC over the last few decades embraced a much more liberal approach to what constitutes a permitted written offer. And more or less, the free writing prospectus emerged as the alternative to these four categories formally that you could employ. And what it basically is any document, any writing that complies with some very basic requirements. It has to be filed with the SEC. There has to be a hyperlink. You know that these were written in the 90s when people used the term hyperlink. There has to be a hyperlink to the registration statement. Okay, you can read this in the case book. The free writing prospectus, though, even though I'm kind of making fun of it now, at the time, I mean, all this stuff seems so archaic. Like, you can only use this form, why not that form? But at the time, this was a big deal. Because at the time, the concern was investors, we don't want to just give them any information. We want to prescribe the categories that they can receive, put it in very clear boxes, and God forbid you just write 5 paragraphs. What's going to happen? They're going to get swept away in the hype and hysteria. And over time, we've come to realize that investors aren't that gullible. And they can read paragraphs, and they can read free-flowing text. And so today, companies, readily attach a free writing prospectus to their registration statement. When they file the registration statement, it will often include a draft, if you will, of the free writing prospectus. These documents will get updated when the registration statement is effective. But if you saw in the Facebook case example, it's sort of like a marketing presentation in a way about the firm. And the sense is like, look, there's just nothing wrong with giving that to investors in an unrestricted written form. And to be honest, I think it's like not the most interesting topic, right? I mean, like, but it's important to know what a free writing prospectus is. What's much more important to the practice of securities law is the roadshow. So another thing that can happen in this window, as you might expect, as a result of the absence of any prohibition on oral offers during this window, is you can have meetings. You can have events, because in those events, you're going to be talking verbally with event participants. Has anyone been to a roadshow? I think at least one of you has. Yes, you have. Sachital, right? Sachital, yeah. Sachital were you a consultant, or I'm trying to remember you were helping out with the legal side, or? Yeah. So she already knows all this stuff, and was at some pretty cool roadshows. I've never been to a roadshow. When I was working at S&C, the junior lawyers were not. Even the senior associates were. I think pretty much like the partners. I don't know, the people that they handpicked. I wasn't one of them. But these are fun events. So I hear anyway. Was it fun? Was it a cool event? Yeah, it was cool, right? So it's just not cool enough. All right, so the roadshow began, as you read in the case book. You always get the history in the case book, right? Like, it'll start you at the beginning. And so at the beginning, there were interviews with senior management, right? So the underwriters would set up these interviews, and that kind of evolved into presentations. Because if we're going to be interviewing the manager and we're going to invite along some potential investors, all of this is permissible, right? Because they're oral offers to sell. Right? That's perfectly fine. Verbal communications are just fine. We're going to naturally see this evolve towards a presentation with slides and PowerPoint. And what's interesting about the roadshow, and what I want you to focus on, besides the fun stories of what happens at these, is to really think about what the roadshow does. So the roadshow is an opportunity to give information to some investors, and not others, about the upcoming offering. So a roadshow is inherently, as the casebook points out, a kind of selective disclosure. Now, what does selective disclosure facilitate in the general framework that we've talked about? It should be like 2 words that you should now. Informed trading, exactly. So selective disclosure in general facilitates informed trading. Now, this brings me to a question I wanted to ask, which earlier, but we had spent so much time on Chris-Craft, we were all ready to move on. But let me go back to it yet again and ask, think about Chris-Craft. Do the considerations around selective disclosure that we saw in Chris-Craft and that are implicated by the roadshow, by giving a presentation to some investors, do those considerations apply to true IPOs where the firm is not actively traded? Put differently, how do you trade in the stock of a company that hasn't gone public yet? And so is there any logic to talking about selective disclosure either here or even going back to the Chris-Craft story when you have a true IPO, when a firm has never been publicly traded before? Who thinks that these considerations apply only to publicly traded firms like Piper, and that we should only be thinking about selective disclosure and informed trading if we have informed trading, that this link only applies if it's a 1934 Act public company? Who thinks that basically all we need to worry about is selective disclosure for publicly traded companies? Who thinks that? Raise your hand. None of you, because I teed it up so that you wouldn't think that. Of course not, right? So can someone tell me why these considerations around selective disclosure and informed trading might nonetheless apply? There can be a few reasons. Let's see if you can pick up a couple of them. Why you might nonetheless worry about informed trading or selective disclosure as inducing informed trading if a firm has never gone public prior to this moment. So there's no public trading or disclosure in the stock of this company that you're at the roadshow for. Is there a reason to be worried? It seems like you all think there is, because you didn't raise your hands earlier. But why? Why might you be worried nonetheless? How can you have informed trading in the stock of a company that's not traded? Anyone? Yes.
Still not sure if this is working.
Felix. Yes.
Because stock prices are independent of each other. And within a market, you could easily have information about one company be disclosed by its competitor. Or information relevant to the price of one company be disclosed by its competitor.
Good. Excellent. Good one. Yeah. Very nice. Felix nailed a good argument. Yeah. So Felix says, look, if Lyft is going public, Uber is going public, information you learn about Uber or Lyft can matter for, I don't know, Toyota. Because, Uber or Lyft are probably going to tell you something about autonomous cars, self-driving cars, right? And the information you learn about self-driving cars at a roadshow could really materially impact the valuation of Toyota. And so we might be concerned then that the roadshow for Uber Lyft is going to lead to informed trading in Toyota, in that example. So that's right. But what's one sort of idiosyncratic peculiarity about insider trading law that we're going to learn about is that generally the law doesn't prohibit that kind of trading. Generally. There are some exceptions, but by and large, if I learn a fact about company A that then lets me infer something about company B, there's no part of securities law that will prohibit me from trading in company B. Now, we haven't done insider trading. That doesn't make any sense yet. But informed trading of the kind that we've been discussing tends to really be a conversation that we have about with respect to information you receive about the company that you're considering trading in. It's totally right economically, both in terms of what folks do in the marketplace, we know that this happens, and in terms of its effect on bid-ask spreads, and in terms of the implications of disclosure. All of the above are true if we redirect the target of my trading to a competitor or to another firm, to another in another industry. So Felix is absolutely right. That's a creative, though, a creative argument, one that sort of takes us to the boundaries of securities law. More kind of, though, if we just focus on the firm who's disclosing at the roadshow, how can you have informed trading if the stock is not traded? Let me get someone. Davia, yes.
Okay, this is probably but,
I doubt it. It's probably right.
I mean,
At least a 50% chance it's right. Go ahead. Go ahead. Yeah.
I don't know, even though the price, like, of the stock was trade, like, if it's the new company or something, wouldn't be supposed to allow you to look at information about the company?
That's right.
Basic stuff.
That's right. No, I think that's exactly right. One of you emailed me. Now I genuinely don't remember who it was. But so I got an email about institutional investors. And does it matter who receives the information? So you could say that it may be different if sophisticated investors, we'll talk more about this, but imagine that the stories here around informed trading might vary depending on whether sophisticated institutional investors receive information as opposed to ordinary investors. And maybe what the roadshow is facilitating is a kind of informed trading by the sort of purchasers, the sophisticated investors who are purchasing the stock, not actually informed trading, but helping them better price the offering. And so the idea that what the roadshow does is not actually facilitate informed trading of the kind that we discussed where the price rises up to some true value. But it's not that the price rises. It's more like the view of investors converges on that value. The consensus view of the market as to what the firm is worth converges on that value. It can be exactly the same process, except that instead of seeing this as time and a market price of trades that execute and inferences that dealers make and all these things we were talking about last week, just think about it as, you know, the view, this is just the opinion of informed investors. And we're going to wrap up a little bit early today. There's an event I'll tell you about in just a minute happening that you're welcome to stay for. But I just want to emphasize that the concern around selective disclosure in informed trading may take on a different light when you're thinking not about bid-ask spreads in terms of prices in markets, but when you're thinking about investors' own subjective valuations. And what I want you to think about in preparation for tomorrow is whether or not the concerns we identified around widening bid-ask spreads and reduced liquidity, whether those concerns apply with equal force when what you're talking about is not a market price, not a bid-ask spread, but rather an opinion that a potential investor holds. You might think that there's nothing wrong with informed trading if what we're doing is just giving certain investors information so that they reach a better valuation of the firm. So the thing to think about for tomorrow's class is how is the roadshow, go back and reread the material on the roadshow, how is the roadshow implicating or not implicating the concerns around informed trading that we discussed last week? And A related thought to that, a related concern is how is the roadshow compensating, potentially? This is a direction to focus on. How is the roadshow compensating informed traders for incurring those information processing costs that we were talking about? Like taking your weatherman friend out to lunch. Remember that conversation? So you might think that what you need the roadshow for is to give these investors a certain advantage over the rest of the public in valuing the stock so that they buy first and exploit the price change. They make a profit that then compensates them for the time it takes them to go to the roadshow. For tomorrow, I want you to think through that story. Ask yourselves why that story makes sense, why maybe it doesn't make sense, and whether or not the roadshow is really an effective tool, whether selective disclosure prior to an IPO is necessary. And while you're doing that, one last thing to keep in mind, you might take a look at a website that I had hoped to walk us through today, but we'll do this tomorrow. It's called SharesPost. So you might have responded to my critique, to my question of how you inform trade in a company that is not traded by challenging the premise that a company like Uber is not traded. Because it actually turns out that companies that are not publicly traded are in fact traded. They are traded by employees and others who have access to markets like SharesPost. And we'll talk tomorrow about maybe a little bit about technically how this happens legally, but economically what it means. So be thinking not just about the roadshow, not just about information processing costs, but how the IPO more generally interacts with private financing like this, like we see here on SharesPost. And what this is going to bring us to, last thought, is kind of the broader question we're seeing right now in securities law, which is how the nature of initial public offerings is changing from being a vehicle to raise capital to something else. Why is that? Because of platforms like SharesPost and others who facilitate raising capital without having to go through the cost and difficulty and complexity of Section 5, right? So those are going to be the topics of our conversation tomorrow. And what I wanted to make sure you all knew before we officially end is that there's going to be an event in this room that you are all invited to. My colleague, Professor Liebman, Jim Liebman, is hosting Payman Ruhanifard, the superintendent of Camden, New Jersey, for a public talk on transformative change in the Camden City School District. And I'm myself not able to stay, but I want to encourage those of you who find public education to be a topic of interest that event will be happening in this room. And so we're going to break now so that they can come in and you can stay for that event. All right. Thank you. Yes.
Yeah.
So one reason that, so imagine if so so that means if we launch in 10, because they bought in at 10, you'll get to capture. That's $10 a pop. Profit comes in. And the question is that getting to that $20 number, right? Because we're not just going to get information.
I just wanted to make sure that this is the right PowerPoint that you're going to have up. I was just looking at the date. It looks a little.
Take that off, yeah.
Okay. All right.
Is that possible?
Yeah, I
Or you just put the
think-
due date, or
Yeah.
the date, whichever's easier.
Okay. You should be all set, okay?